mutual funds and yields share a bond, pun intended. A regular viewer of our series will understand this pun right away because debt mutual funds may invest in different kinds of income instruments like bonds, debentures, government bonds. But back to our topic, yields, that we hear the market talk about, and bonds, which are debt mutual funds invest in. Just like we track the Nifty and Sensex for equities, the debt market tracks the 10-year government yield as a benchmark. If this yield moves, it influences the prices of debt and money market instruments, and thus it impacts the market value of the debt fund in our portfolio. Let's first understand what exactly is yield and what impacts it. Bond yield, or simply yield, is nothing but the fixed interest or coupon paid by a bond divided by the market price of a bond. Not the face value, but the market value. So your bond's face value may be worth 1,000 rupees, but the market value could be 990. As you can decipher from the equation, if the yield goes up, the bond prices will go down and vice versa. Which will then lead you to ask, what determines yields? Because that at the end decides the value of debt mutual funds in your portfolio. The yield on government's debt instruments is considered a benchmark for many other bond and debentures, and here's what impacts it. Number one, inflation. If the country is seeing a rise in the cost of things, the yields on the government instruments spike because there's a possibility that the RBI may hike interest rates in the country to rein in that inflation. Then there's government borrowing. The more the government borrows, the more costly it's going to get. In general, when corporates or even the government use bonds to borrow money from the market, yields start spiking because of higher supply. It's just basic demand and supply actually. Now you don't need to worry about remembering all this formula every time. Just understand the rationale. When there's a surge in yields, prices of bonds already issued and in the market go down. This is because newer bonds and other securities will be carrying the new interest rate closer to what's prevailing in the market, which is higher and hence more attractive. Similarly, when yields fall, bonds will rise, and so will your debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.